Welcome to the Deep Dive. This is the show where we take these huge stacks of source material and we try to boil them down into something you can really use, some actionable insights to give you that intellectual edge.
Exactly. And today's topic is a big one.
It really is. We are tackling the very architecture of modern finance. We're talking about those high-powered, often high-stakes instruments known as financial derivatives.
And it's such a crucial deep dive because, derivatives are so much more than just these complex bets you hear about. They're really the essential plumbing of global risk management.
That's a great way to put it.
We're talking about financial instruments whose value, it doesn't come from within themselves. It's derived from the performance of another asset. And that other asset is what we call the underlying.
Okay, so let's unpack that with a core definition right away, just to build our foundation.
Okay.
So a derivative is a contract whose value is purely dependent upon, or, well, derived from, the value of another asset or even a benchmark.
Right. And to ground this in a really practical, if simple sense, just think about controlling future prices today. A farmer who agrees today to sell their entire corn harvest at a fixed price, say 6 months from now,
Right.
regardless of whether a drought sends prices soaring or if a bumper crop makes them crash.
Yeah.
That farmer has, in effect, entered into a derivative contract.
So the corn harvest itself is the underlying asset.
Exactly. The corn is the underlying, and the contract's value comes purely from how the market for that corn moves.
That function of transferring risk, that's absolutely key. So our mission today is to go beyond those simple definitions. We need to really dissect the mechanics of this whole system, contrast the four main types you see everywhere: forwards, futures, options, and swaps.
And critically analyze the legal and the risk frameworks that govern them.
Exactly. And we'll be paying close attention to the Indian regulatory context, which is highlighted really well in our source material.
And that regulatory structure, it's not optional. It dictates everything, from whether a contract is even legal to how it gets executed. At a high level, the sources confirm that in India, derivatives are formally classified as securities.
Under the SCRA, the Securities Contracts Regulation Act of 1956.
That's the one. And that classification is incredibly important. It subjects all this trading to the stringent oversight of a really comprehensive regulatory framework. It ensures a baseline of investor protection and, systemic stability that just wouldn't be there otherwise.
Okay, so let's start with that foundation. A derivative contract is essentially worthless without its underlying asset. So if we're looking across the entire economy, what kind of assets can actually serve as that bedrock for these agreements?
Well, the spectrum of what can be an underlying it's vast. It really reflects the needs of both hedgers and speculators across pretty much all asset classes.
So how do we categorize them?
We generally break them into two broad categories. First, you have the financial underlyings. This is the traditional world of finance. It includes individual shares and bonds, various other debt instruments, and, very importantly, indices of prices of underlying securities.
And using an index like the Nifty or the Sensex in India, that's a strategic choice, isn't it? You're not just betting on one company's future.
No, not at all. You're taking a leveraged view on the directional momentum of an entire market segment. It's a tool for portfolio hedging or for what you might call macro speculation.
So it's much broader.
Precisely. It allows for that broad-based risk management or exposure without needing to, actively invest in every single stock in that index. The flexibility there is what drives enormous volume.
Okay, and the second category?
The second major category is commodities. This covers all the tangible raw materials that really drive global industry.
And within commodities, our sources detail a pretty diverse spread.
Absolutely. You have the precious metals, like gold and silver, which serve as both industrial inputs and, as safe haven investments.
Right.
Then you have the critical energy resources, oil, coal, natural gas, where price volatility is a massive global concern for everyone, consumers and producers alike.
Yeah.
And then, of course, you have agricultural products, which are often known as agri-commodities.
Agri-commodities. So we're talking about things like wheat, cotton, sugar, coffee. Why are derivatives so vital in that particular space, especially for, say, a large food processor or a multinational company?
Because for them, price certainty is everything. It's paramount for their profit margins. I mean, a coffee roaster that operates on thin margins just cannot survive a certain doubling of the price of coffee beans.
It would wipe them out.
It would.
Yeah.
So by using derivatives that are tied to these agricultural products, they can lock in their future input costs. They're basically transferring that volatility risk away, ensuring their supply chain and their profitability stay stable. And that, in turn, leads to more stable prices for you as a consumer.
Now, let's pivot to the legal architecture. Our sources show this really fascinating duality in the Indian framework. You have the SCRA and the RBI Act providing slightly different, though overlapping definitions. That just highlights how complex regulation can get with these instruments.
Well, the duality really reflects the different responsibilities of the regulators. The SCRA from 1956, which governs the trading of securities and market integrity.
Yeah.
Its definition sees a derivative as a security that's derived from conventional things like debt or shares. But critically, the definition also explicitly includes something called contracts for differences, or CFDs.
Okay, that's a key distinction. What are the specific mechanics of a CFD that make it necessary to include it as a security under the SCRA, especially since no physical asset is ever supposed to change hands?
Well, CFDs are, at their core, just an agreement. The parties agree to exchange the cash difference between the opening price and the closing price of the underlying asset.
Purely a price bet.
It's a pure bet on price movement. And they are highly leveraged instruments, you sometimes see leverage exceeding 100 to 1, that allow for very rapid speculation. Because they function so much like futures contracts, but are often traded over the counter, and because that high leverage poses a systemic risk.
The regulator has to step in.
Exactly. The SCRA makes sure they're regulated just like other securities.
Then we shift over to the RBI Act of 1934. The Reserve Bank of India, they manage monetary policy, currency, the banking system. So their definition is logically centered on instruments related to stability and debt.
Right. The RBI's main concern is systemic risk and the financial sector's exposure to, say, big swings in interest rates. So their definition focuses on instruments that will be settled at a future date and whose value comes from fluctuations in interest rates, exchange rates, or even credit ratings.
So this is where things like interest rate swaps and foreign currency options come into play. So what's the practical implication of having the RBI manage one set of these things, currency and rates, and then SEBI, through the SCRA, manage the other set, like equity and indices?
Well, for the big financial institutions, the commercial banks and so on, it creates a pretty significant compliance challenge. There's a potential for jurisdictional overlap, especially with really complex hybrid products.
Can you give an example?
Sure. If a bank is involved in foreign currency trading, which is RBI jurisdiction, but it needs to hedge that exposure using, say, equity instruments, which is SEBI's jurisdiction, they're suddenly managing two parallel regulatory standards. The SCRA is about market fairness and reducing fraud, while the RBI Act focuses on capital adequacy and overall financial stability. So these institutions have to navigate this really intricate landscape.
And that brings the whole concept of legal or regulatory risk into very sharp focus. It's not just some abstract idea in a market like India's, is it?
Not at all. I mean, when the enforcement of a multi-billion-dollar contract hinges on its legal standing, any change in regulation becomes a massive concern. Legal risk is simply the danger that a contract can't be enforced. Maybe a law is interpreted differently, or a specific instrument is suddenly deemed to lack proper legal standing.
And we've seen this happen globally.
We saw after 2008 when new regulations were imposed on certain OTC swap markets. If the RBI or SEBI changes the classification or the margin requirement on an existing instrument, the entire hedging strategy of a major institution could be nullified or just become too expensive overnight. It's a foundational, non-market risk that you always have to budget for.
It really shows how the legal fine print is just as important as the price of the underlying asset.
Absolutely.
All right, let's move from that legal framework to the core financial philosophy of derivatives, the zero-sum game. This concept is, it's often used to describe how value moves within a derivative contract. What does that term really mean here?
So the zero-sum concept means that the net positions of the buyer and the seller in any given derivative contract, when you combine them, they always amount to zero. It's a closed system of wealth transfer.
So no new wealth is created.
Exactly. Mathematically, the profit gained by one counterparty is exactly offset by the loss that's incurred by the other counterparty at the moment of maturity or settlement.
So if a big institution profits by, say, 50 million rupees on a currency derivative, its counterparty must lose exactly 50 million rupees. It's a risk transfer, not a wealth creation mechanism like, say, a company that grows and generates new economic value.
Precisely. It's pure risk absorption. You can think of our source example of gold futures contract. The buyer takes a long position because they believe the price of gold will rise. The seller takes a short position because they think the price will fall. When the price moves, the party that was right gains, and the party that was wrong loses, and the amounts just net out to zero.
But I want to challenge let's say, the purity of that zero-sum conclusion, because our sources do suggest it's not quite that simple. If you factor in real market friction, the practical costs, does that equation still hold up?
That is such an important point to synthesize. The zero-sum conclusion only holds true on the theoretical assumption that there are no taxes and, critically, no transaction costs.
Which is never the case in the real world.
Never. The moment you introduce brokerage fees, exchange fees, clearing charges, taxes, the collective loss that's incurred by the two parties is technically greater than the collective gain. The difference is the cost of participating in the market, which gets siphoned off by the intermediaries and the state. So while it's zero-sum for the pure risk transfer between buyer and seller, the total financial utility is actually slightly negative because of that friction.
That moves us really nicely to settlement mechanisms, how these contracts are actually finalized. Historically, and still very common for indices, is cash settlement.
Right. Cash settlement is the operational choice when physical delivery is either impractical or just unnecessary, like with an index future. The parties simply settle by exchanging the price differentials in cash when the contract expires.
The key being that the actual physical underlying asset is never delivered.
Exactly. It's often simpler, faster, and it reduces a lot of logistical headaches.
However, the sources point to a major strategic shift mandated by SEBI in India for stock derivatives, a move towards physical settlement. Why this change, and how is it being rolled out?
This is a really significant regulatory push. SEBI has mandated that all stock derivatives must move compulsorily to physical settlement. This means that when the contract expires, the seller must actually deliver the underlying shares, and the buyer has to accept and pay for those shares.
That sounds like it adds a huge amount of logistical complexity, especially for retail traders. What's the thinking behind forcing this shift?
The main rationale is to curb excessive speculative leverage and increase alignment with the cash market. When settlement is only in cash, derivative positions can become detached from the reality of the underlying stock market.
I see.
By requiring physical delivery, SEBI forces speculators to either have the capital to actually acquire the physical shares or to square off their positions before expiry. This reduces the potential for manipulation, it strengthens the link between the derivatives and the equity markets, and it helps ensure that derivative prices more accurately reflect the true price of the underlying asset.
And it's not happening all at once?
No, the implementation is being done in a phased manner. They're focusing first on high liquidity stocks and then gradually expanding to others based on size and activity.
Okay, so let's talk about systemic risk. If these contracts are so highly leveraged, how do the exchanges protect themselves and the whole system from a massive default? That safety net is margining.
Margining is the absolute foundation of secure derivatives trading on any centralized exchange. The clearinghouse, as you know, it acts as the legal counterparty to every single trade, but it needs collateral to do that.
Of course.
So the clearing member has to deposit funds or securities as collateral, that's the margin, before any trade is even executed. This ensures that even if a trader has a catastrophic loss, the clearinghouse has enough collateral to offset their commitments and guarantee the trade for the other party.
And the primary requirement here is what's called the initial margin. How is that amount determined, and what level of safety is it actually designed to provide?
The initial margin is the minimum capital you need to hold a position. And it's not some arbitrary number. It's specifically calculated using historical volatility and risk models. And it's designed to be large enough to cover potential losses in 99% of cases based on historical daily price moves.
So it's a statistical model.
It is. In simple terms, the exchange uses a model, often something like a value at risk or VAR approach, to figure out a margin that can absorb almost all conceivable volatility that might happen between when a trade is initiated and when a defaulting account could be liquidated.
You mentioned the calculation is highly technical. Can we dig a bit deeper into the components, specifically SPAN and ELM?
Absolutely. The initial margin is mostly made of two mandatory parts. The first is SPAN. That's SPAN, Standard Portfolio Analysis of Risk Margins.
Okay.
SPAN is a portfolio-based risk management system. It calculates the maximum potential loss a whole portfolio could suffer over, say, one day under 16 or more different market scenarios. It includes large price moves, volatility changes.
Yeah.
It calculates risk dynamically across all the positions you hold.
And the second part, ELM, that's for the really unexpected, the extreme loss.
That's right. The ELM, or extreme loss margin, is also mandatory, and it covers the risk beyond that 99% confidence level that SPAN covers. It's a buffer for those sudden, unpredictable shocks, the tail risk or black swan events that fall outside the normal range of market behavior.
So this is a direct response to past market crashes.
It is. The use of SPAN and ELM reflects the lessons learned from crashes in the 90s, where systemic risks spread like wildfire. These complex margin systems were put in place globally to make sure clearinghouses had enough capital to withstand sudden, massive market shifts.
And it's a direct application of risk management theory. Our sources also highlight the direct relationship between the size of the margin and the volatility of the asset.
That relationship is immediate and automatic. The size of the initial margin is directly related to the volatility of the underlying stock. If a stock is highly volatile, it's a greater risk of a huge daily loss for the clearinghouse.
So they require a larger initial margin.
A significantly larger margin. And if a stock is stable, the margin requirement is lower. This dynamic scaling ensures that traders with high-risk exposure have to commit more capital, which promotes systemic safety.
And for our option buyers, there's a specific premium margin involved.
Yes, the premium margin is paid upfront by the buyers of option contracts. See, unlike futures, where both parties post margin because both have potentially unlimited loss, an option buyer's loss is already capped at the premium itself.
So they can't lose more than they paid.
Exactly. So the premium margin is just the value of the options premium multiplied by the quantity they bought. It's the immediate cost for securing that right.
Let's end this section by defining a key market metric, open interest, or OI. It's often misunderstood. People mix it up with trading volume. What is it, and what does it tell us?
Open interest is the total number of outstanding derivative contracts that haven't been settled and closed out yet. It's not like trading volume, which just measures the total trades in a day. OI measures the commitment of capital that's currently sitting in the market. It's a vital measure of market depth.
So how does that open interest figure actually go up or down?
Okay, so OI increases when a new buyer and a new seller come into the market and create a brand new contract. That represents new capital flowing in.
And it decreases.
It decreases when an existing buyer and an existing seller meet to close their respective positions. The contract is effectively neutralized, and that outstanding commitment disappears from the books.
So if I'm an existing buyer and I sell my position to a new buyer, the OI doesn't change because the position just transferred hands. It only changes when the contract is actually liquidated by offsetting the original obligation.
That's the core mechanism, and that's why technical analysts watch OI so closely. Increasing open interest, especially if the price is also rising, suggests new money is confirming the trend, showing strong conviction.
And a decrease.
Decreasing OI, particularly if the price is moving the other way, suggests that traders are actively closing out their positions, maybe taking profits or signaling that a reversal is coming.
Okay, let's transition now to the first two major contract types. Both of these involve an obligation to transact at a future date. We're talking about forwards and futures.
And their similarities really end where their structural risks begin.
Let's start with forwards. The tailor-made agreement. This is the original derivative. Can you define what a forward contract is and what makes it so unique?
A forward contract is a simple, direct, bilateral agreement between two parties. It's often two institutions, or maybe a corporation and a bank. They agree to buy or sell a specific asset at a future date for a price they decide on today.
And its key feature is that it's an over-the-counter or OTC transaction.
Exactly. That OTC nature is the source of both its flexibility and its inherent danger. It means the terms, the exact quantity, the quality specs, delivery location, the price, all of that is negotiated specifically between the two counterparties. They aren't traded on centralized exchanges, which is why we call them bespoke or tailor-made.
And they exist to fill a very specific need.
They exist to satisfy highly unique hedging requirements that no standardized exchange contract could possibly meet.
And the main motivation behind them.
It's all about risk avoidance. Whether you are long forward, so you're agreeing to buy, or short forward, agreeing to sell, the essential goal is just to fix the price today to completely eliminate the risk of bad price movements in the future.
But this custom two-party structure introduces two critical risks that exchange-traded derivatives were designed to remove. Let's touch on liquidity risk first.
Well, because the contract is so uniquely tailored, other market participants generally won't be interested in it. So if you need to get out of your position before it matures, finding someone else willing to take on the exact specifics of your custom agreement can be extremely difficult. You might just be stuck holding it until it expires.
And the second, much more severe risk, the very reason futures exchanges were invented, is counterparty risk.
Right, also known as default or credit risk. This is the danger that the institution or the party on the other side of your deal will fail to fulfill their contractual obligations.
And this usually happens when the market moves against them.
It's most common, then yes. If the forward price you locked in is now catastrophically unfavorable for them, that counterparty has a huge financial incentive to just default. And since you're only relying on their balance sheet and their credit rating, default is a very real possibility, especially with smaller partners.
So if you're relying solely on the counterparty's integrity, doesn't that inherently limit who can safely use forwards? It seems like it would block out smaller, high-growth companies.
It absolutely does. The forward market is heavily dominated by large, highly rated institutions, major banks, top-tier corporations, precisely because they have the credit strength to manage and absorb that kind of counterparty risk.
So how do they manage it at that level?
To mitigate this, institutions rely on standardized documentation, like the ISDA Master Agreement. It defines how collateral needs to be posted and how termination events, like a default, are managed across these huge, complex OTC derivative portfolios.
And this inherent risk in forwards is exactly why futures contracts were created. They're designed to give you the price fixing of forwards while getting rid of that risk of default and illiquidity.
That's it. Futures achieve this through standardization and security. Like forwards, there are agreements to buy or sell an asset at a future date for a set price, but they operate through a centralized trading platform and are fundamentally standardized contracts.
So how do futures get around that massive counterparty risk that plagues forwards?
The mechanism is the clearinghouse. When a trade is executed on an exchange, the clearinghouse immediately steps in and becomes the legal counterparty to both sides of the trade.
A process called novation.
Exactly. So the buyer isn't contracting with the seller anymore. They are both contracting with the clearinghouse.
Yeah.
And the clearinghouse, backed by the mandatory margins paid by both parties, effectively guarantees the settlement. It completely eliminates that direct credit risk between the original traders.
And the standardization is the key to liquidity then.
Correct. Futures have standardized terms. The exchange predefines the quality, the quantity, the expiration dates. This makes every contract fungible or interchangeable with any other identical contract, and that ensures a deep liquid market, where exiting a position is simple, which solves the liquidity risk of the bespoke forward market.
Let's focus on the pricing of futures. How is a future price determined today for delivery months down the line?
The pricing is based on what's called the cost of carry model. The price of the futures contract is determined by taking the spot price, which is the current market price for immediate delivery, and adding the cost of holding the asset until the delivery date.
So futures price equals spot price plus the cost of carry. What actually goes into that cost of carry?
Well, it includes things like the interest expense of borrowing money to buy the spot asset, plus any storage costs, for commodities like oil or grain and insurance. For a financial asset like a stock, the carry cost is mainly the financing cost minus any income you get from the asset, like dividends.
And the relationship between these prices is called the basis.
Yes, the basis is simply the difference between the spot price and the futures price.
Okay, now we get to the really elegant mechanism that keeps the market rational. Spot future convergence.
This is the essential self-correcting mechanism of the market. As a contract gets closer to its settlement date, the carry cost has to naturally approach zero. Right, there's just no more time left to incur holding costs. This forces the spot price and the futures price for the same asset to become identical right at expiry. If they didn't, a riskless profit opportunity would exist.
And that brings us back to spot future arbitrage. This is the mechanism that ensures that convergence actually happens by exploiting any little misalignment.
Arbitrage is like the market's efficiency police. If the basis, that difference between spot and futures, gets bigger than the cost of carry, an arbitrager can lock in a profit with zero risk. They simultaneously buy in the cheaper market and sell in the more expensive one.
Can you walk us through a full arbitrage cycle in detail?
Sure. Let's say the futures price for gold is way too high relative to the current spot price, plus the cost of borrowing and storage. An arbitrager would simultaneously buy gold in the spot market at the cheaper price and sell the futures contract at that artificially high price.
Okay.
They then just hold the physical gold and wait until expiry. When the prices converge, because they must, the arbitrager buys back their futures obligation and sells their physical gold. And they realize that guaranteed profit from the initial price gap minus their transaction costs.
And that very action helps correct the price.
Exactly. The act of buying spot and selling futures increases demand for spot gold and increases supply for futures, which pushes the prices back into alignment. It enforces the law of one price.
All right, shifting gears now to contracts that are defined by a right rather than an obligation, we're moving into the world of options.
The option contract is fundamentally about choice. It gives the buyer the right, but crucially not the obligation, to buy or sell an asset at a stated price, which we call the strike price.
And to get this right, the buyer pays an upfront fee.
A non-refundable fee, yes. It's called the premium, and they pay it to the seller, who is often called the writer.
And we have two basic types, the right to buy and the right to sell.
That's right. The call option gives the buyer the right to buy the underlying asset at the strike price. This buyer is bullish. They're hoping the market price rises way above that strike price.
And the opposite.
The put option gives the buyer the right to sell the underlying asset at the strike price. This buyer is bearish. They hope the market price falls way below the strike.
Option pricing is where the complexity really ramps up. The premium isn't just a simple fee, it's a combination of two distinct values.
Correct. The premium is made of the intrinsic value and the time value. Intrinsic value is the measure of how much profit the option would give you if you exercised it right now. It's the excess of the current market price over the strike price for a call, or the other way around for a put.
And importantly, only in-the-money options have this value.
Critically, yes. Only in the money, or ITM, options have a positive intrinsic value. If exercising it would result in a loss, the intrinsic value is just zero.
And the time value accounts for all the uncertainty and hope and potential future movement.
Time value, or extrinsic value, is the extra price you pay on top of the intrinsic value. It reflects the possibility that the option's value will increase before it expires. Two things really dominate time value. Time decay, the idea that the value drops a little every single day.
And volatility.
And volatility, yes. The more volatile the underlying asset is expected to be, the higher the time value, because there's just a greater chance of a big favorable price swing. But time value is always diminishing. It hits zero right at expiry.
We use the concept of moneyness to describe an option's current profitability. Let's quickly define the three states.
So in the money, ITM means the option has intrinsic value. For a call, the market price is above the strike. For a put, the market price is below the strike. At the money, or ATM, is when the strike price is exactly equal to the current market price. It has maximum time value, but zero intrinsic value.
And the currently worthless state, out of the money.
An option is out of the money, OTM, when exercising it today would lead to a loss compared to just trading on the spot market. For a call, the strike is higher than the market price. OTM options have zero intrinsic value. They're made up entirely of time value, which typically just disappears at expiration unless the price moves your way.
The payoff profiles are really the single most defining thing that separates options from forwards or futures. The buyer and the writer have these fundamentally opposite risk structures.
They do. For the person who is long on the option, the buyer, the risk is strictly limited. Their potential loss is capped at the premium they paid. They can never lose more than that initial fee.
But their upside.
If the price moves dramatically in their favor, their profit potential is, in theory, unlimited. So you have limited risk for unlimited reward.
But the seller, the writer, takes on the mirror image of that risk. They're essentially selling insurance, aren't they?
That is a perfect analogy. The person who is short the option, the writer, takes that premium, and that premium represents their maximum possible profit. They're getting paid to take on risk, but because they have the obligation to honor the contract if the buyer exercises it, their potential loss is theoretically unlimited.
Wow.
I mean, if they sold a call option and the stock price triples, they are obligated to sell that stock at the much, much lower strike price, which could mean massive losses.
Which means clearinghouses must treat option writers very differently than option buyers.
Oh, absolutely. To manage that unlimited loss exposure, writers are subject to extremely rigorous margining requirements. This is especially true for naked option writers, people selling options without owning the underlying asset to cover themselves. They have to post very high margins to ensure they can cover a potential unlimited loss, which links right back to our talk about SPAN and ELM margins.
And a quick note on the exercise type in India.
In the Indian market, most equity and index options are European options. This means they can only be exercised on the expiry date. This limits the writer's risk a little bit compared to American options, which can be exercised at any time, but the writer still faces assignment risk if the option is in the money at maturity.
All right, let's move to our final major contract type, swaps. This shifts our focus completely from asset trading to institutional cash flow management.
A swap is, in essence, a private, usually OTC agreement between two parties to exchange or swap cash flows on specified future dates. They're primarily used by big corporations and banks to manage their long-term financing risks.
And the most common forms?
The two most common forms, as noted in our sources, are interest rate swaps and currency swaps.
The calculation of these cash flows relies on a reference point called the notional amount.
Yes, the notional amount, or notional principal, is the principal sum that's just used to calculate the periodic interest payments being exchanged. This is a critical distinction. The notional amount is never actually exchanged between the parties. It's just a reference size for the contract.
Let's focus on the most popular type, the interest rate swap, and specifically the benefit it offers a corporate entity.
Okay, imagine a large corporate borrower has a floating rate loan. This means their interest payments change every 6 months based on some benchmark rate. This creates a lot of uncertainty.
Right, for budgeting.
Exactly. So to stabilize their finances, they enter an interest rate swap. They agree to pay a fixed rate cash flow to their counterparty, and in return, they receive a floating rate cash flow from that counterparty.
So on their balance sheet, the floating payments they get from the swap cancel out the floating payments they owe on their loan. It effectively converts their floating rate obligation into a predictable, stable fixed rate.
That is the core benefit. It's an incredibly powerful risk management tool. Now, you could also consider a currency swap. This involves an agreement to exchange both the principal amount and the interest payments, but denominated in two different currencies over a set period.
What's the strategic use of a currency swap?
Currency swaps let multinational corporations access financing in a foreign currency where they might not have a strong credit rating. By using a swap, they can achieve a lower effective interest rate. For example, an Indian company borrowing in the U.S. market might swap their USD liability for a JPY liability with a Japanese bank, effectively getting better financing rates by leveraging the Japanese bank's advantage in the JPY market.
And circling back to that notional amount, if the principal is never exchanged, why does the size of it matter so much in terms of systemic risk?
Well, while the principal isn't exchanged, the systemic risk is enormous because the derivative exposure of the global financial system is often measured by the total notional value of all outstanding swaps. When that notional amount massively outweighs the actual capital held by the counterparties,
A small move has a huge impact.
it means that a small negative cash flow swing on a massive notional principal can instantly cause a huge financial institution to default, which creates a domino effect across the whole financial ecosystem.
Okay, so we've broken down the four structures. Now we have to address the why. What function do these instruments actually perform in the economy? Our sources identify three primary reasons: hedging, speculation, and arbitrage.
And these three functions are symbiotic. They really define the entire ecosystem. Let's start with hedging, which is the legitimate cornerstone of risk management.
Define hedging for us, but with the kind of strategic analysis our audience needs.
Hedging is a defensive move. It's using derivatives to protect the value of an investment you already have or to lock in the cost of a future transaction. You're effectively transferring the risk of bad price movements to someone else. The hedger uses the derivative market to maintain their desired profit margin, not to chase huge returns.
Can you give us a detailed example of commercial hedging in an emerging market context?
Sure. Imagine an Indian car manufacturer that imports critical components priced in US dollars but sells its cars in rupees. They face massive currency risk.
Of course.
So they can enter a forward contract or buy options for the USD INR exchange rate to lock in the conversion cost for their future payments.
Yeah.
They are not trying to profit on currency movements. They're just buying insurance to make sure the cost of their components doesn't suddenly spike because the rupee depreciates. It protects their balance sheet.
And for someone to transfer risk, someone else has to absorb it. That brings us to speculation.
Speculation is the aggressive side of the coin. It's taking a position based purely on a view of where you think future prices are going without having an underlying asset to protect. The speculator is betting on direction. If they think crude oil prices will fall, they sell oil futures. Their only goal is to gain from those price movements.
Speculators often get a bad rap, but they're essential for the system to work. They're not just gamblers, are they?
They are vital risk absorbers.
Yes.
Speculators provide the necessary volume and the willingness to take the other side of a trade, which is crucial for enhancing overall market liquidity. If that biscuit manufacturer, the hedger, needs to sell their risk, there has to be a speculator willing to buy it. Without speculators, hedgers often couldn't find a counterparty, and the whole risk transfer mechanism would just seize up.
They get paid for taking that risk.
Exactly, in exchange for potential profit.
And finally, the efficiency mechanism. Arbitrage.
Arbitrage is the pursuit of risk-free profits by exploiting price differentials between two linked markets. As we discussed with spot future convergence, arbitrageurs trade to reduce those gaps, making sure that prices across different markets stay aligned with the principles of efficient capital markets.
So the relationship is entirely symbiotic. Hedgers need speculators to take their risk, and arbitrageurs make sure the prices that hedgers and speculators are using are accurate and consistent with the law of one price.
It's a perfectly integrated ecosystem. But we have to detail the dangers inherent in this ecosystem. Let's talk about the risk side.
The primary risk, the one that can lead to catastrophic losses, has to be leverage risk.
Leverage is the double-edged sword of derivatives. Because margins are relatively small, often just 5 to 10% of the contract's value, derivatives let investors take on massive exposures with a relatively small amount of margin.
Which amplifies everything.
It amplifies potential returns, yes, but it also magnifies the potential for significant losses. A 1% adverse price move on a contract with 20x leverage results in a 20% loss on the capital you deposited. That can trigger rapid margin calls and even account liquidation.
And we also have to mention the risks related to just execution and administration.
That all falls under operational risk. This includes things like the failure of internal systems, the risk of fraud, errors from inadequate documentation, or just mistakes in executing complex trades. The more layers of complexity you add, like customizing an OTC swap, the higher the operational risk becomes. And of course, there's always legal risk, the ultimate threat to a contract being enforceable.
And as a safety measure, participants are always directed to a key document.
Yes, the exchanges mandate that all participants have to read the model risk disclosure document. This is a comprehensive document that contains critical, detailed information on all the trading risks in the equities and the futures and options segments. It serves as a formal warning about the potential for rapid, highly leveraged losses. It's basically an acknowledgement that the investor understands the inherent risk before they start trading.
Let's briefly cover the specialized landscape of the Indian market as our sources highlight, starting with its history.
Derivative trading was first introduced in India in June of 2000. The equity derivative markets there have since just exploded in volume. They've become among the largest in the world, driven largely by retail participation in indices and the hedging needs of large institutions.
And the commodity market is segmented onto specific exchanges.
It is. Trading in commodity derivatives, underlyings like gold, energy, agriculture, is handled on specialized national exchanges like MCX, NCDEX, and ICX, as well as the major equity exchanges NSE and BSE, which have opened their own commodity segments.
And these are crucial for industrial users.
Crucial for refineries, food manufacturers, anyone who needs to manage their input costs.
And the management of currency risk falls under specific instruments as well.
Yes, currency derivatives are essential for managing global trade exposure. They're available for the major currency pairs relevant to India: USD INR, UR INR, GBP INR, and JPY INR. Plus, cross-currency pairs like UR-USD and GBP-USD allow large institutions to manage risks between two non-rupee currencies.
And a final note on an important self-regulating body, FIMMDE.
FIMMDE, the Fixed Income Money Market and Derivatives Association, is a voluntary market body. It's made up of financial institutions, commercial banks, and primary dealers. Its role is essential for market integrity. It devises standardized practices and documentation, like standard swap master agreements, which reduces confusion and operational risk.
It also settles disputes.
It does. FIMMDE also acts as an arbitrator for disputes between its member institutions, which promotes orderly conduct in the OTC markets, where regulatory oversight can be more challenging.
So overall, when we pull back, the positive economic function of derivatives is clear, despite the massive risks they carry.
Absolutely. They enable better and more nuanced risk management for corporations and banks. They inject massive liquidity into underlying markets. And perhaps most importantly, they improve price discovery by allowing all these diverse leveraged views to be incorporated into the current pricing structure, ensuring prices reflect a broad consensus of what the future might hold.
So we've journeyed through the customized, risky world of OTC forwards.
The guaranteed, standardized world of exchange-traded futures, the choice-driven structure of options, and the institutional utility of swaps for converting liabilities. The takeaway is that derivatives are really the indispensable toolset of modern finance. They serve as both crucial risk management utilities and as extremely powerful, high-stakes speculative instruments.
The ultimate synthesis for you, the listener, is to internalize the core nature of this trade. Derivatives are about the figurative transfer of risk or value. At the moment you sign a contract, no money or asset actually changes hands. It's all about managing a future obligation and the management of future price risk. It's financial expectation weaponized through leverage.
And that potent leverage leads us right to our final thought.
Oh.
Since derivatives allow investors to take massive concentrated exposure using very small margins, consider the societal implication of that. How much of the volatility we see in the prices of really liquid underlying assets like benchmark oil or gold is genuinely driven by real-world physical supply and demand? And how much is disproportionately influenced by the extremely rapid, massive speculative movement of capital out of those highly leveraged derivative markets? The transfer of risk is powerful, but when it's leveraged 20 to 1, it can create price ripples that shake the entire global